Most people think they lose money in the stock market because they don't understand stocks. That's not true. People lose money because they understand fear very well. Let me explain. In 2020, when the market crashed, millions of Americans sold their stocks. Not because they were stupid, not because they were careless, but because fear felt logical. Their portfolios were falling every day. News headlines were screaming recession. Friends were saying, "I'm out. I sold everything." So they sold too. At the bottom, fast forward a few months, the same people who sold in panic started buying again. Why? Because prices were going up. Markets were making new highs. Everyone on social media was talking about profits, so they bought back at higher prices. This is how most people invest. They buy when they feel safe and sell when they feel scared. And that is exactly backward. Imagine a 35-year-old professional in Texas, good salary, $401,000 in account. Some stocks, a mortgage, 2 credit cards. In 2022, the market falls. His portfolio is down 20%. At the same time, mortgage rates are rising. Credit card balances are increasing. Monthly payments feel heavier. Fear builds. So he does what feels responsible. He sells his stocks to protect what's left. But here's the problem. He didn't remove risk. He locked in losses. A year later, the market recovers. Stocks are up again. Now he feels confident. He starts investing again. But this time, he's buying the same stocks at higher prices. Same companies, same businesses, just more expensive. This pattern is everywhere in America. People buy stocks when their portfolio is green, their job feels secure, their debt feels manageable, and they sell when markets fall, debt pressure increases, loan payments feel stressful. This has nothing to do with intelligence. It has everything to do with human psychology. Your brain is not designed for investing, designed for survival. When prices fall, your brain sees danger. When prices rise, your brain sees safety. Markets reward logic, but humans follow emotion. Now let's connect this to debt. This is important. When people are overloaded with car loans, credit card debt, high mortgage payments, they have less emotional tolerance for market drops. Even a small fall feels unbearable. That's why people with high debt sell faster. Not because markets are bad, because their financial structure is weak. Here's a simple truth most people never hear. You don't panic in markets because markets fall. You panic because your life has no margin. Too much debt removes patience. Too many loans remove flexibility. And without patience, investing fails. Smart investors don't try to predict markets. They design their lives so they don't need to panic. They keep manageable debt. Avoid lifestyle inflation, build emergency buffers, accept that volatility is normal. So when markets fall, they don't run, they wait, or they buy. People ask, should I buy stocks now or wait? That's the wrong question. The real question is, can I emotionally survive a 20% drop without selling? If the answer is no, the problem isn't the market. It's the structure of your finances. Markets don't destroy wealth. Bad decisions during fear do. People don't buy high and sell low because they're foolish. They do it because debt pressures them. Fear feels rational, and patience is expensive. Time rewards patience, not intelligence, not timing, just discipline. If you remember one thing from this video, remember this. The stock market is the only place where people run away from discounts and then complain they missed the opportunity.